Thanks, Peter. Can everyone hear me all right with that? Again, great pleasure to be able to come back. As Peter said, this is our first face-to-face meeting for 2 years. We obviously missed 20 and 21 due to COVID, and then the ability of getting people in one room and travel and a lot of the other sort of circumstances. I think the online meetings were successful, but I do feel that it is nice to be able to come and actually look at shareholders and actually talk about the issues that relate to the company. I just a little bit of explanation about this photo of a bunch of dirty looking blokes. This is basically the final crew at our Canterbury mine. So we closed the mine about 18 months ago, and these are the guys that really carried it through. So I've got a bit more to say about them as we go towards the end of the discussion. Usual disclaimers, all of the numbers that are being used here are either actuals or relate to forecasts. Most of the forecast numbers we're using relate to the financial year, and including the guidance are based on our budgets that have been carried through to end of June 23. The board's already been introduced. I'd also like to introduce the senior leadership team. Basically everyone is in a room apart from Craig Pilcher down on the bottom corner. Craig unfortunately came down with COVID on Monday, so he couldn't attend, which is very unfortunate. And as I said, we've got all of the other senior leadership team in the room. Took the advantage of that yesterday with a team meeting, so it's not all just travel for nothing. Our safety journey. I just wanted to sort of concentrate on this slide for a sec. Normally you'd see a pretty graph of the lost time and the total recordable numbers over the last 12 months. I can sort of tell you it's reasonably flat. So in one way, that's sort of saying that the strategies that we put in place 12 months ago, we had some quite wide variations within those actual statistics, particularly during the COVID period. One of the things we put that down to was the fact that our senior leadership team couldn't travel to the site. So the sites were pretty much operating in isolation, and so you miss that interaction with people who aren't involved in the day-to-day action, so they can actually see things that others can't, and there's a whole concept about normalisation of risk if you're operating in a certain circumstance all the time, that you actually start walking past things that can actually be a hazard, but you don't see it because you're so used to it. So our safety stats, we're in no ways happy with it. 3.3, for us, we do about 1 million man hours a year. That equates to about 3 lost time injuries over the last 12 months. So that's the rolling average. And 11.5 relates to total recordable injuries that have occurred. So 11 total recordable injuries in the last 12 months that relates to that. So that's people that required treatment off-site or a first aid type injury. And obviously with a lost timer, that means they couldn't come to work the next day. So we're not happy with that stat. But one of the things we have been working on very hard is a thing called field leadership, which is basically a program where we've got people who aren't normally engaged in the normal inspection regime go out and actually do inspections, but more importantly do conversations with people carrying out work. And we are seeing a lot of that interaction becoming valuable, and I think that's why we're seeing a plateauing of a flattening off of our safety stats in terms of the negative performance indicators. I mean, we do run a lot of positive performance indicators. There's a number of other programs that are run constantly through the company, and we're recording those and we map the progress of those. One of the other really important things though is that there's been a large study done of a number of fatalities over a number of years in the Queensland mining industry. And even though that doesn't relate directly to New Zealand, it certainly does in terms of the experience of the investigators and what they're finding as being the causes of fatalities are not closely related to the causes of minor or even lost time injuries. So there's a real disconnect between those two. And so a big part of our focus next year and ongoing now is really making sure that the controls that we put in place to stop major fatality or major events that could lead to either a single or multiple fatalities are being carried out. So we call that critical control verification, and a part of the field leadership is actually moving into that space now where you're actually going out and physically checking that the control that you said was going to be in place is being put in place. And it won't affect the stat that we're seeing here, but what it'll do is for those low probability, high consequence events, like for us is a shot firing event, it's a big truck meeting a little truck, it's a high wall collapse, that sort of thing, where you won't see that in the safety stats, you won't see that in the hazard reports as such, but when the day it happens, you will then see a fatality report. So that's the ones we're concentrating on stopping. Just again, a snapshot of our contribution to the New Zealand economy. We employ just over 550 people directly, another couple hundred contractors, and that sort of, in terms of our employees, is about 70 million goes into the economy directly from those as employment. We also then pay about another 210 million of cash into the economy through suppliers, and that's everything from diesel, parts, explosives, and all the other sort of consumables that we use as part of a normal day-to-day action. We paid 34 million in taxes. On the positive sort of notes, we had 3 finalists in the Minerals Council. We ended up Minerals Sector Awards. We actually won one of those for health and safety, for occupational health response. The one up in the top corner though, the 215 kilotons, what that relates to is we've got customers like, say, Mitsubishi Coke and Chemical that have been coming to Stockton and buying coal for 48 years this year. And you ask the question, why would they drive or sail a ship past some of the biggest coal producers in the world to come and buy New Zealand coal? And the reason is because they get value and use for buying that coal. They got to send a boat further. They're paying the same price for it, but what they do is they use that between 8 and 10% of their blend is made up of New Zealand coal, which is high in vitrinite, so high in the reactive components, and low in ash, so low in the impurities. So what it means is for their blend, they actually use about 14 kilos of coal less to make the same amount of hot metal if they didn't use that in the blend. And if you equate that to our 1 million tonnes of production, that's a scope 4, so an abated emission of about 315,000 tonnes of CO2 equivalent. And that's sort of, they've been doing that for 48 years because they recognise that years ago in terms of cost. Obviously, 14 kilos of coal, that's got a cost to it, and by not having that, that's a reduction. What a lot of the emissions trading schemes around the world, including New Zealand's, doesn't recognise scope 4 emissions, so abated emissions. But where it's really important for New Zealand and the sort of like the message I've been trying to get across to some of our politicians, particularly the existing government, is this relates directly as well to primary production in other centres. So with a good farmer, for instance, who looks after his soil, who captures a lot of carbon in his soil, but then produces a tonne of buttermilk, gets the same price for that tonne of buttermilk as the guy that just rapes and pillages, doesn't look after his waterways, doesn't look after his riparian zones, for instance. So, there needs to be a way of actually recording that. So we're working with some of our customers now within their jurisdictions to see if they can then get credits for these type of savings by actually following through their product stewardship. And that's what it's about. It's about basically taking a good quality product and then using it in another jurisdiction to lower the overall emissions across the world, because as we've been told, this is a global problem. Our markets, obviously all our production at the present time comes from New Zealand. Our markets are pretty much as you've seen before. We sell coal into Australia, India, one boat this year into China, that's why China's on the map this year, South Korea, Japan, and obviously we've got the project in Canada, which we'll talk about all as we go through. In New Zealand, we've got the 2 mines in the North Island, Maramarua, Rotowara, which are the ex-Solid Energy operations, Stockton on the west coast, Canterbury, which is not shown here, just west of Christchurch, which is in the final stage of rehabilitation, and Takatimu, which supplies process heat coal into the lower South Island in particular. Where does our coal go? 80% of our volume goes into steelmaking. So that's both about 50% of our domestic coal goes into actually the New Zealand steel plant, and 100% of our export goes into steelmaking. So that's a really important part of the portfolio. And obviously we all understand, where that ends up in construction, transport, and a lot of other places. We also are the only supplier in New Zealand, apart from imported coal, into Genesis, which is the last remaining power station in Huntly. A little bit different than say if you're used to the Aussie experience or overseas experience with coal plants or coal-fired power stations. This is a peaking station. So when the wind doesn't blow, when the gas is not available, when the lights are about to go out, the coal-fired power station fires up and basically maintains what is generally about 80 to 90% renewable energy system and electricity system in New Zealand. This is the last gap. The last thing turned on and the first thing turned off. So again, a really important part of the New Zealand energy mix. And again, lucky enough to with Sam to go to the Sakate plant in Japan to have a look at the Mitsubishi chemical operation. And there's not one thing wasted out of that ton of coal that we're sending them. Obviously the coke comes out of that and goes directly into steel making and other chemical production. the volatiles come off and go directly into a power station next door, and the underflows, the tars and whatever else, which in the past would have been a terrible byproduct, they're quite proud because they're making the, at that time, the brakes for Valentino Rossi's GP bike. You know, that was quite a proud display in their thing. So not one part of the coal, you know, it's a bit like a sheep going into an abattoir here, not one part of that is wasted. It all goes into a valuable product. That's gone on the recording now, Pete. Yeah. As Peter's already alluded to, you know, I mean, there's ample evidence out there. We don't have to invent this stuff, that steel is going to be an important part of the economy going well forward past 2050. I mean, it's an integral building block of all infrastructure, no matter whether you're building it to reduce greenhouse gases, or, you know, like as in the way of windmills and other infrastructure, or just in everyday life. I mean, an EV is still highly dependent on steel. So, as Peter's already alluded to, I mean, we and the rest of the world takes the view that coal, and coking coal in particular, is going to form an important part of that economy. And also, I mean, you know, it's already been recognised, the US and in Europe, as a critical mineral, not so much in New Zealand, because New Zealand hasn't come up with a critical minerals list yet, but it will be, and it is, a critical mineral. I mean, our business is very much based around the two halves. I mean, 50% of production goes to export. We've already sort of covered most of that, where that coal goes to, and the 50% goes into the domestic business. I mean, it's a really important natural hedge to us. When we had the opportunity of looking at the solar energy assets, we quite deliberately locked the North Island, which had been always making money, onto the export business, because it was making money on one boat and losing on the next one at that point in time. So, you know, we didn't want to keep going back to the market, so we locked those two together. That gave us the natural hedge of the New Zealand dollar revenue, New Zealand dollar cost domestic business, with then the fluctuating with basically in terms of price and FX with the export business. And I think, as we see on the next graph, that's been well and truly repaid. You know, this is looking at our earnings over the last 5 years, and then with our anticipated earnings going into FY23. Obviously, there's been some ups and downs. But if you have a look at the light blue at the bottom, that's the domestic business. So, you know, it's been reasonably consistent. We've seen a little bit of a pullback in the last couple of years, combination of that we've dropped some volume, obviously Canterbury coming out of the market. We're down a little bit at Rotowaro as well, but we're also in a development phase at Rotowaro, which will now start to repay itself over the next couple of 3 years. And we'll look at that as we go a bit further forward. And as I already said, you know, 80% of our sales now go into steel making exclusively. If you look at that on the revenue side, it's about 90% of our revenue comes from steel making. 10% comes from a combination of process heat, which is value add to New Zealand primary production, or into production of electricity. Looking at Stockton, reasonably consistent tonnage, and we're going to see that sort of tonnage carrying through for the next 5 or 6 years. Into existing sort of markets, we produce 3 main products. We've got a prime hard coking coal, which we get 100% of benchmark. Most of our coal goes out as semi-hard, which gets around about 75 to 78% of the benchmark, and then we've got 2 sort of products that we've grouped in as one. We've got a high sulphur and a high ash. I mean, our high ash is only about 6.5%. Most of the other coal goes out, you know, always less than 5%. And we've got a high sulphur one again, which again goes up to about 3.5% sulphur, and allows us really then to mop up and to sell most of the coal that we're mining out of the Stockton complex. The other interesting thing was, like, 19 was pretty close to break even. Sorry. FY21, obviously highly affected by COVID. Just coming out of the COVID period, then China put the ban on Australian coal, which then caused another redistribution of the supply and demand equation. You had then US coals being diverted from existing markets into the Chinese market, and then the coal that was originally destined for Chinese market having to find a new place where the North American coals were going to. So that took about 6 months, and then we saw the price starting to come up again. So again, it's very much driven, you know, around supply and demand, as Peter said. You know, our main markets were pretty much equally spread when you look at it between India, Japan, South Korea and Australia. The Australian market's actually growing quite well. That's one steel at Whyalla. And we are doing one boat this year into China, and that's a different than we have done in the past. That's actually a semi-hard boat. We as Bathurst, BT, haven't done any real marketing into China. Obviously, our marketing guys have got relationships there. We have done sale, or in the past they did sale of thermal shipments into China. The main reason we get sort of the pricing that we get for it, because we've got a good technical team, and they work very closely with the actual makers of the coke. So whether that's a steel producer, vertically integrated, or like Mitsubishi, whereas a coke maker, which then sells it, they work directly with those people in terms of getting their blends right and getting our coal the best use into that blend. And so with China, we actually haven't got that same face-to-face relationship. So that's why we haven't been in that market in the past, but what we want to do is keep a good geographic spread of customers. Even though we've only exporting 1.2 million tonnes, we've actually quite well insulated from geographic type events. This is just a shot of Stockton. I don't know if it's the best shot of Stockton, but it's Stockton on a really good day. We've got rehab in the foreground. This is the top of the web dump. That's quite new rehab that's in the process of being it's been shaped, it's been topsoiled and then planted, and the trees are quite deliberately poked up like that. That's actually habitat or places for birds to roost. And then looking north, we've got the Hope Lions development on the left-hand side and the main Millerton pit looking down. And then further afield, you're looking right up into Karamea or north of the mine site. So you can also see the staggering change of altitude between the sea was where the main rail runs and the mine site itself. So that's about 750 metres of vertical lift. I mean, this site gets about 6 or 7 metres of rain a year. And in fact, in August this year, we had just on a metre of rain in the 1 month. So, it's a testament to the site that they managed to get the production levels they do with the quantities of rain. So looking at the export business now, both North Island and our Takatimu mine in the South Island, we have seen a drop off in tonnage, but that's going to be halted over now. We're going to be end up around about that 1 million tonnes again next year. We've had an increase in sales at Maramarua, an increase in sales at Takatimu, and also Rotowara moving into a more consistent band. And in terms of EBITDA, we're going to see a recovery again back up to around the 25 this year and about 30 odd million next year as we get further into the lower strip coal of the Rotowara mine. And again, the sales mix in terms of product tonnes, about 50% going to steel making, the other about 40% going into process heat, and then 10% into electricity. This is looking at the Rotowara mine, so this is looking north again. The high wall we're actually standing there, that's the where the Waipuna West extension. We'll do a cutback on that and expose those same coal seams that you see down under the near the rehabbed area in the middle of the photo. The bit of sort of development that looks like it's going on in the middle, that's actually forming a new stream bed, and then we'll relocate the stream, which is shown by the tree line sort of running around the green rehabbed area. That stream will then be diverted into here, and that allows us then to extract the remaining coal, which is about 750,000 tonnes, out of the raining area within that. And at the same time, then we'll then commence cutting back this wall, and that gives us about another 4 years worth of work on top of the 2.5 years we've got in that sort of immediate area. This is Maramarua, and some would say it's probably not a very pretty shot, but it's a very indicative shot of Maramarua. It's all clay stones, highly affected by rainfall, and we do have some stability problems there. But the prize, as you can see right in the middle, about 12 metres of low ash, reasonable CV coal that's well sought after by steelmakers and the power station. Takatimu, this is down in the deep south. So our PC4 2000 working here. This is what we call the Black Diamond block. We own this land. It was a forestry block prior to us starting to mine it. We purchased it off the forestry company. We've got about 4 years worth of work left in this area, and then we've got the new Brighton project, which is basically on top of the hill behind that you can see. We'll move into that area. Just want a couple of shots of Canterbury. So Canterbury's just west of Christchurch. This was taken about 2 months after we actually finished final production, but it shows the sort of exposed high walls as we're moving further to the east. Some of the areas that were already being sort of shaped off. This originally was a combination of forestry block, so the foreground is the forestry block, and a normal pastoral farm in Canterbury with sheep and cattle. So this is the same site taken about a month ago. So the main void there has now been free draining. We did a slot cut through where the old infrastructure used to be. That's now been planted out of natives, and there's also been about a half a hectare of wetlands formed, and all the rest of the area has been grassed over. So that'll have sheep on it again in about 12 months' time. So this site will go from being productive mine about 18 months ago to being a productive farm and forestry block with trees planted on it. The trees have already been planted in the northern part of that, or the eastern part, sorry, looking into that photo. And those landholders will get their land back into full value probably in the next 2 years. So, we were quite proud of the work that was done here, and I was sort of saying that, the photo of those guys, it's a testament to them, when they were told that the mine was going to be shutting, they didn't drop their bundle, they just got on with the next part of the job, and I think that does typify our workforce to the T. So what we're anticipating is that obviously we're going to have an uplift in terms of our EBITDA guidance for FY23, mainly on the back of increased export pricing, but also a reduction in overheads and a slightly increased tonnage out of our South Island business. So we're anticipating somewhere between 120 and 130 million EBITDA. We've got a sort of a stay in business capital spend of about 20 million, so around about $10 a tonne. So really outside of that, that cash will hit the account. That guidance is based on a fairly flat forward curve. That was done in early September. It has sort of come off a little bit. The forward curve sort of has been in contango for most of this year. We are seeing it now slightly in backwardation, but it's still sitting above $250 going 12 months out. And as we try to indicate, we've got just a bit over 200,000 tonnes of coal, hard coking coal that's forward sold at around about 300 US, which equates to about $286 per tonne Kiwi, and that's about a third of our production. And we will maintain that going out. What we're really doing with the hedging program though is just locking in super profits. We haven't got debt. We're not looking to keep sort of minimum a baseline. It's really, and when we see a price and we can get a tonnage up to 12 months out that we think is then going to add to a super profit, we will try and lock that tonnage in. And again, I think the slide typifies where we are today. I mean, we've got 100 million in the bank in Bathurst. That's the 65% of the BT plus 100% of Bathurst account. That does include, some about $4 million that's sitting in restricted term deposits as bonding. We've got a healthy balance sheet. We've got zero debt apart from we've got about 20 million combination of some finance leases for yellow goods and some interaction with a major customer, New Zealand Steel and Genesis, over some prepayment for overburden that's slowly flowing through the system as we sell coal to them over the next couple of years out of Rotowara. And as we've already stated, we've got a strong earnings capacity of somewhere in that sort of 120 to 130 range. So it does sort of beg a belief why yesterday or the day before we were worth 146 million on the exchange. It doesn't, if you back the cash out of that, it sort of doesn't put much value on the asset that's actually generating a hell of a lot of cash again. So, we think there is a number of reasons for that. I think, as Peter sort of alluded to, L&M is one of those. We have got a couple of structural issues with our joint venture that we're working our way through, and obviously, the market and our existing shareholder base in some ways were disappointed that we didn't declare a dividend. But as we've sort of have tried to explain through that, I mean, we have got the cash still. It's not like we're spending the cash on frivolous things. That money will come to the fore once we can get these structural sort of impediments out of the road. So in terms of, that's sort of the business as we stand today and for the next 12 months. So obviously we're an extractive industry. We're chewing away at our resource, we're chewing away at our reserves as we speak. How do we keep replenishing those and how do we keep that business going forward? So across sort of each of the major areas, so if you look at South Island, North Island and our export and then ultimately into Canada, there is a strategy, there is a plan. So New Brighton is the plan for the South Island domestic. I mean, we're seeing some customers drop out, but we're also seeing customers that are trying to transition to wood waste. So we're part of that transition. As Pete said, we embrace that. We're working with our customers. Wherever they send the truck to fill up with the coal, when we're not putting coal in a pile with a for sale sign out the front of the pit, all of our coal is sold. I mean, that's one of the key things with the domestic business is that, prior to entering a new block, like we've done with Rotowara, with the Waipuna West and now the Waipuna West extension, that's completely underwritten by customers. There's a contract, there's in fact prepayment in some places, to actually back that investment. So that's a very important part of our strategy. So same with New Brighton. So Waipuna West extension, that'll start up later this year or before the end of the financial year, and there's about 4 years worth of coal expected in that at the existing sort of rates. So somewhere around 800,000 tonnes. We've got M1 as an extension at Maumaroa, so its KCQ pit will be extended into a new area. And again, there's about 7 years worth of life in that, and we're anticipating getting started on that again later in this financial year or early in the next financial year. Rotowaro North is a virgin block. It's been underground mined before. It's about the same distance north of our existing infrastructure as in the rail load out and the washery as the stuff we're mining to the south is. So it's in close proximity. It's on a combination of private and LINZ land, so Crown land, and not associated with DOC, I might add. We're a long way from a mine there. We're probably, we're looking at somewhere around FY27. We've secured the rights to the coal. We're just working our way through the Crown coal parts of that, and then we've got sort of agreements in principle with the landholders that we need to then carry forward with. So with Stockton, there's a range of products, because at Stockton we run a range of pits to actually blend to come up with our major product mixes. So Hope Lines is in the semi-hard sort of militant extension type range. Cypress South is again around about the same timing. That's in the semi-soft but really low ash, down to 2% ash. Rockies North is our high Romax area, so it's a very difficult mining area, very steep, but it makes up sort of like it's the high Romax part of the PHCC and the semi-hard blend. And the upper wire is the extension really of the Cypress South stuff. So it's a semi-soft on paper, but again it sort of runs around about 2.5% ash, reasonable sulphur levels, and again is a good blend partner for Hope Lines and some of the other existing areas. And the Buller Coal project is still very much there. We're still drilling some holes on it. We've got evaluation process going on with escarpment, but given the size of the footprint we've got there, it's expensive coal, and so where we do see it playing a part is probably in some later years, from 26 onwards as a blend partner for Stockton, because it's a low sulphur coal, it's a high vitrinite content again, and it's also a high fluidity coal, so it does play a part in maintaining some of the blends out of Stockton in partnership with some of the other coals that are remaining on that site. And then Crown Mountain, we'll sort of discuss that a bit further, but that's obviously, we're in a joint venture with Jamison with that one. We do think we've got a really good option. We own 22% of the project. We've got the ability to go into 50% by the payment of 106 Canadian, and that will only be decided once we've actually got the permitting in place, we've got all the consents, and we've actually got the project financing pretty much underway. So, if we sort of look at the combination of all those things I was talking about, so within our existing operations, somewhere out to about 24, 25, 26, we've got reserve bases that carry us through with existing product mixes, existing customers. And then there's a resource to reserve conversion, as you've seen with a project mix that then carries again the same product mix and the same sort of tonnages through until at least the end of this decade. So I suppose, the interesting parts is then with Crown Mountain, that's been anticipated to come in 25 or into FY26, 25. Depending on how long the consenting process takes. That then takes us to under management up to about 4 million tonnes. So, and that's all going to be coking coal at that addition. So at that point in time, you are then operating in a company that you've got 90% of our sales coming from tonnage that's actually coming from steel making, and 10% coming from remnant of process heat. So the Canadian project, the metrics. This was last updated when was that last updated? 2019, I think. At the time, using 155 US per tonne hard coking coal. So obviously, we've seen quite a paradigm shift in our mind in that base and that long-term pricing. I think the consensus pricing now is sort of sitting around 200, but again, it's still a very profitable project. North of 450 million EBITDA. NPV. Pre-tax based around 155, it's sort of in the lower third of the price quartile, and obviously there has been some price escalations over that time. This will need to be renewed, but our focus totally on this project now, and Jamison's focus is getting their resource consent. So the consent application has been submitted to the regulatory authorities. That's now going through an adequacy phase. The important part of that is we need to have buy-in from First Nations. If the First Nations do not buy in at this point in time, there is no project. So We've got good affirmative responses from them, and in fact now we're going into the next level with the subgroups, so the tobacco group, for instance, which are now actually supporting the project. So that'll be an important step. So with that, I think the latest news from Jamieson is they're anticipating that in quarter 3, or early in first quarter of the calendar year. Once that has been accepted, basically the stables get pulled out of it, it gets distributed through the various agencies within the regulatory group, and then you start the process of Q&A, and the start of the clock process starts in, which is about 9 months, but generally this will take somewhere between 12 and 18, and I think at the moment we're using 24 really to complete the whole process, including getting permitting. And again, I've already covered, we've got this option, at our option, whether we invest a further 106 million Canadian to take us up to 50%, and that 106 Canadian becomes the first seed for the build. So the build at the present time is somewhere around about 300 million US. So that's the combination of yellow goods, digging the hole to get started, and the fixed plant, the wash plant, the rail load out, and those sort of intrinsic requirements. Peter's already alluded to the fact that we are generating good cash. We've got a runway of say 6, 7, 8 years in front of us now with our existing operations generating somewhere around the same cash if you assume the same sort of export pricing. So we are looking for other businesses, and our priority obviously is coking coal. I mean we're not marching away from coal. We realise there's a finite resource in New Zealand. We're going to maximise our recovery of that finite resource, and then utilise that cash to then get us into the next phase of the business. Part of that utilising cash will actually be capital management, giving some of that back to shareholders, but another important part is then looking for further investment. And as Peter said, in terms of bulks or commodities that are going to be part of any transition going ahead, like copper, for instance, that sort of thing, or leveraging on our existing base of good knowledge and mining experience in New Zealand, if there was assets within New Zealand, then we would look to do that to basically then lower our overall fixed costs within New Zealand, which then helps us generate more cash out of our existing assets as well. So look, before we go into questions, I mean, one of the things, about every 6 months I go through all of our crews, and one of the things I try to instill in our guys is that they're getting a lot of pressure from third parties. I mean, kids coming home from school and saying to them, Mum or Dad, our teachers told us that you're destroying the world because you're a coal miner. But, it's actually the converse. Coal miners should be very proud of the job they do, and as Peter said, we are unashamedly a coal mining company. But the products we're using are used every day by most people in the world, whether it's for energy, or whether it's for value add to primary production, which is a mainstay of New Zealand's economy, or whether it's building the building blocks for our economy through steel, infrastructure, and all the other things that we rely on our everyday life. We should be proud of the job we do, and I'm very proud of my team and and our employees. And I'd just like to thank shareholders for their long-standing support, and also, and our communities and the government people that we deal with who do support us through our activities. So, again, thanks very much for coming to the meeting and listening, and I'm more than happy to answer questions as we go through. Thank you.